Hi everyone, welcome to today's video. So let me start today's video by sharing a very interesting observation and let us discuss how it can be applied to the stock market. So you would have often seen that people who are preparing for IIT JEE, they would be preparing for AIEEE also. Similarly, you would have seen that people who write the UPSC exam because it is very uncertain, they also end up writing the bank PO exam or other government oriented exams. Why is it that people do this? In real life, the term is called as hedging. And in life, we do hedge because, for example, if a kid is unable to clear IIT JEE, then probably if he or she has prepared for IIT JEE properly, probably they can clear AIEEE and at least their career is safe. Now, the same principle applies in the investment domain also. Now, what I have seen is that many investors, what they do is that they believe so strongly in one stock that they put all their portfolio. For example, someone has a 1 lakh rupee portfolio, they will go and invest that in one single stock. And if that one single stock falls, it becomes a nightmare. So it's very important for us to understand the basics of hedging, and that is what I'm going to teach you on today's video. Please like this video. It would indicate to me that you value this type of content, and I will then shoot an advanced version of the hedging strategies. If this video gets 20,000 likes, I will release a video. Okay, so let's get the video started. And three parts. One, what is hedging, how to do hedging, and third and finally, I will build a portfolio, a growth portfolio for you and hedge it in front of you. So hedging is a very complex topic to explain. So let me use some examples so that the point becomes clear. So let us look at example number one. So let's assume that this is your portfolio. Now, a hedged portfolio could mean that you have taken positions across different industries, right? For example, you have 20% FMCG stocks. Similarly, you have 15% tech stocks. Then you have 10% chemical stocks. Then 20% pharma stocks. So that is a portfolio that is diversified and it is a way to hedge. For example, you would have seen that in 2020, when COVID crisis hit, stocks, even good stocks like Bajaj Finance, it fell a lot, and HDFC Bank, it fell a lot. But the FMCG stocks did not fall. In fact, some of the FMCG stocks, after falling very, very briefly, they rose and made new highs. For example, HUL made a new high. So if you had FMCG and tech stocks and finance stocks, tech and finance stocks in such a situation would fall, but FMCG will rise. So this is the first example. Now let me pick a second example from my own portfolio that you can do an intrinsic hedge. Now what do I mean by intrinsic hedge? So let us understand this by taking the example of small finance bank. So recently I've been speaking very positively about small finance bank. I feel that there will be a good growth in small finance bank. And I've been speaking about it for roughly 6-7 months now that small finance banks are going to do really well. And therefore I have taken positions across various small finance banks. For example, some of my small finance banks are Equitas, Ujjivan Small Finance and AU Small Finance. Now what happened was that roughly 2-3 months back, there were some issues with Ujjivan Small Finance Bank's management. As a result, Ujjivan Small Finance Bank tanked a lot. So here is a chart for you, and Ujjivan Small Finance Bank fell a lot. So resultantly, I was making a loss on Ujjivan Small Finance Bank. Then on Equitas, there was no problem. Equitas kept on going up and up and up generally, and I was sitting on a huge profit here. Similarly, AU Small Finance Bank was giving decent returns. If I combine stock 1 plus 2 plus 3, I was able to make a good return from this narrative, this intrinsic narrative that I was speaking about small finance bank, that I'm betting on small finance bank, and I've hedged my bets. Now let me share some simple strategies to hedge and how you can easily do it, and also explain some basic points around it. So the first way to assure hedging or good hedging is that you take positions across different asset classes. Now what do I mean? That rather than just investing your money in equity, which is an asset class, you also take positions in bonds and you also take positions in cryptos. Now, please don't start dropping off because I have talked about the word cryptos. You can replace cryptos with commodities or whatever you like, right? Depending on what type of portfolio you want to build. If you want to build a defensive portfolio, keep crypto out. If you want to build a growth portfolio, keep crypto in, right? So back to the topic. Now, in case you want to hedge, what you should do is that you should not just go and invest in one asset class, which is equity. You should also go and invest in a range of asset classes because one asset class can act as a hedge to the other asset class. Usually it is seen that when money leaves the equity market, it flows into the bond market. Similarly, when it leaves the bond market, it traditionally flows into the equity market. So I'll explain this point more when I actually create a growth portfolio and show you, but I hope you understand the concept of asset classes here. Now let's move on to the second point. So the second category of hedging will be called as intrinsic hedges. So rather than buying only HDFC Bank, if you're looking to buy large commercial banks in India, take positions across HDFC, ICICI, Kotak. So these are all good stocks. Rather than sticking to one specific bank, you can take positions across multiple banks depending on your portfolio size. Now you would say, Akshat, by this logic, I'll have like 60, 70 shares in my portfolio, and I have read that, you should have like highly concentrated portfolio. See, everyone has their own opinions on what the portfolio size should be. All I'm simply trying to tell you is that for retail investors, you need to be well diversified, because you don't know when this Ujjivan small finance type of situation might crop up and you might end up sitting on notional losses. So therefore, I feel that if you're picking similar category of stocks, for example, in my opinion right now, I don't see that, for example, HDFC Bank will grow by 3x and ICICI Bank will not even grow by 2x. That is not going to happen. So I will consider something like Kotak Bank, HDFC Bank, ICICI Bank as similar banks, and I will consider them to be one category of stocks that I'm purchasing. Now, third could be portfolio hedges. Now, portfolio hedges in simple terms means that you have a combination of aggressive and defensive stocks. For example, aggressive stocks are usually considered to be tech stocks or finance stocks. A prime example would be Bajaj Finance. When COVID hit, Bajaj Finance fell by roughly 60%. But on the flip side, a defensive stock would be something like ITC or HUL or SBI. No, not SBI. SBI is not a defensive stock. It's a good trading stock. But over to SBI on some other video. So the bottom line is that if you have a lot of aggressive stocks on your portfolio and if you want to take counter positions, buy defensive stocks and defensive industries. Now comes the fourth point, that you can also hedge in terms of geography. For example, if you feel that, India is an emerging economy and there could be certain range of problems because Pakistan is going through an economic crisis and Sri Lanka recently went through an economic crisis, Turkey is going through an economic crisis. All these are emerging economies. So what is the hedge that you can take? You can go and invest in international locations like US and bunch of other different countries. So that is a way of hedging. I'm just explaining all the options that you have. So I'm not comparing these options. Now comes fifth and final option, which is futures and option. I'll keep the explanation very easy here because this is a complex topic, and if there is enough interest, I'll make another video on FNO. Now usually what large investors or big investors do is that they take positions in the cash market. So cash market means that you and I buy stocks and we take delivery. So that is cash positions. So for example, if let's say that they are buying 1000 stocks of ITC today, so they feel that the price is undervalued, then they might be structuring their future contracts 3 months from now in such a way that it takes a counter position from their cash market position. If this is complex, please don't worry because FNO is slightly technical, so I can't explain it on this video itself. But I hope you get the concept that when you see FIIs, DIIs buying, please understand the difference between buying in cash market versus futures and options market. Now let me build a growth portfolio and hedge it in front of you as to how am I hedging a growth portfolio. Now, why have I picked a growth portfolio? Because I am a growth investor. I take slightly more risk and invest. I am not a defensive investor. So this strategy is only applicable to people who are looking to build a growth portfolio, and I will tell you how to hedge it. So first and foremost, I need to decide what type of assets to pick that will give really good growth. So according to me, my top 3 assets in the growth portfolio would be Bitcoin, Ethereum, and tech related stocks. So this is how I'm making this growth portfolio. Now, how is it that I will hedge something like Bitcoin? I need to first and foremost understand that why is it that the Bitcoin prices go up and down and what is the fundamental value of Bitcoin. According to me, the fundamental value of Bitcoin is that it is a great store of value. Now, what do I mean by store of value? It simply means that, for example, if you compare Bitcoin to cash, so if you have 100 rupees right now in cash in India right now, you go and deposit that money in HDFC Bank. By next year, how much return will you be making? You will be making 102 rupees because the savings rate interest is 2%. But what is the inflation in Indian economy? So it is close to 6.5-7%. So in real terms, that 100 rupees roughly becomes 95-96 rupees. So that is a poor store of value. On the flip side, Bitcoin is an excellent store of value as per my understanding. Now, why am I saying it's a good store of value? Because if you track the Bitcoin prices, when has Bitcoin given aggressive up moves? It has given the most aggressive up moves whenever quantitative easing happens. For example, whenever the government decides to print more money, the cash gets devalued, but BTC goes up. Why? Because again, people don't want to stay in cash. They would rather pick that cash and invest across different asset classes. And BTC becomes one of the most prominent store of value. Now comes the question that now I understand at a conceptual level what the value of Bitcoin is, but can you tell me how to hedge it? The natural hedge of Bitcoin is cash. Now, I'm not the type of a person who believes too much in cash per se or keeping money too much in cash. I would rather go and invest in assets. So I will find the next most stable thing that I can invest my money in that is still somewhat a growth asset. So I would go and invest my money in defensive stocks, right? For example, if I buy something like HUL, now again coming back to my favorite stock, which is HUL, and this is one of the key reasons why HUL is such a great stock for me, because I use it as a hedging purpose also. Because I know that, hey, if BTC market falls down, it's not as if that HUL will go down with it. There is very little correlation between BTC and HUL, right? So therefore, HUL will be somewhat of a hedge for me. I'm again saying that HUL is not a perfect hedge for Bitcoin, but since I do not prefer to keep money in cash, maybe I'll explain it on some other video why. So therefore, I will put money in defensive stocks as a natural hedge. Now comes the second growth asset for me, which is Ethereum. And now you need to understand what is the fundamental value of Ethereum. The fundamental value of Ethereum, according to me right now is twofold. Number one, it allows to DeFi to scale up. Right? DeFi is decentralized finance. In case you don't understand the term, please Google it. It is just next generation finance that is picking up, where centralized authorities like bank are not really required to perform the admin tasks. I've made separate videos on DeFi, so please go and watch it. I will link it somewhere here. But if you don't understand this concept, you will not understand this logic. So please go and watch it. If I explain it again, the video becomes very lengthy. So the first narrative for Ethereum is DeFi. This is the first core value add right now for Ethereum. The second core value of Ethereum comes from metaverses, smart contracts, / NFTs, right? So these all three things are tied up. I will just lump it as a metaverse play. Now, what is going to happen? The way I see it, I can be completely wrong, but the way I see it is that in the next 10-15 years, the DeFi space is going to pick up. And if the regulatory bodies or if there is regulatory clearances to DeFi banks, then this space is going to blow up. And this is where the next value migration of banks will happen. For example, value migrated from PSU banks to private banks like HDFC and they became really big. The next major leg of growth will happen in DeFi space when DeFi banks figure out a way to work with authorities. When retail participation in DeFi increases, this is where the next gen banking will happen. So what is the hedge for DeFi? So for example, if Ethereum falls completely and this DeFi narrative blows over, then what is it, right? Then we are back to Web 2.0 type of private banks, HDFC, ICICI, Kotak, etc., etc. So I'm still aggregating a lot of these type of stocks, right? And Ethereum is a hedge. Now, roughly speaking, you might ask Akshat that how much money should I be putting in Ethereum right now versus buying something like HDFC? So the ratio that I would suggest is that put 10% here and 90% here. Why? Simply because of the fact that this space is risky and this has the potential to go 1000x. And this is likely to only go 10x. So if this goes 10x, you are still making money, even if you lose this 10% here. And if this space gets completely cut, these private banks, then still this 10% portfolio will become huge, humongous, because there are extensive growth potential in DeFi. Now, second is the metaverse narrative for Ethereum. So I'll not explain it on this video. In case you want, I'll make part 2 of advanced hedging strategies. So give it a like. 20,000 is when I'll make part 2 of this video. Now comes a third growth option, which is tech stocks. Now, there are a range of tech stocks and here I will do internal hedging. I explained earlier what internal hedging is. Now here, if I have, let's say 1 lakh rupees to invest. Now, rather than buying just 10 stocks of tech, I will go and purchase usually 20-30 stocks of tech. Why is that? You will say that Akshat, you are crazy. You are buying so many stocks with 1 lakh rupees. This is just pure madness. Now here, you have to understand the industry fundamentally. A lot of tech is getting reworked, re-innovated. A lot of AI, RPA based companies. In India also, a lot of tech innovation is happening. Many of the new age minted unicorns have gotten listed, be it Paytm, Zomato, this, that, right? So the narrative is very clear that, okay, hey, we are going to move towards tech. And these type of companies, for example, if Zomato survives, right? And if Zomato beats Swiggy in the race, it will become 100x. There is absolutely no reason why it would not, if it wins the race. But I don't know if it will win the race. So therefore, I will put a little bit of money on Zomato. That's it. Then I will move on to the next tech stock. Similarly, I will disperse this and I will adopt VC model in tech investing in India because I don't know who the clear winners are and there is no indication of who these clear winners are. But I know for a fact that tech industry is going to grow whichever company survives. So let's say that there are 100 companies in India right now and only 5 great companies survive. These 5 companies are going to 100x. So this 100 rupees definitely becomes 500 even if I'm losing money on 95 companies. So this is the broad game that I'm playing, and I'm doing internal hedging here. Again, please press the like button and I will make a part 2 of this video where I can explain more about this strategy and thought process. But I hope that you enjoyed this video and I will see you the next time.